Student. Today we're going to look into the cost estimation, and this is considered new topic in this food product management course, and certain terminology here you already know in your accounting class. Okay, so we hope that knowledge can guide you to come up with the cost estimation for product. Here we focus on food product. So on cost control overview, cost control means how much we spend to create a particular product. So you have to take effort to manage the spending. Okay, so the ultimate goal for any business is to minimize the cost and maximize the profit. Okay, so every business need to make more money than it spend in order to survive. That is its sales. So sales here we can tell as revenue. So your revenue should be always higher than your cost, so then only you can see a profit. Okay, if your cost is higher than revenue, definitely you are making loss. Okay, so what is revenue? Revenue is the income from sale before expenses or costs are subtracted. Okay, that is revenue. So cost here is a price an operation pays out in the purchasing and preparation of its product or the providing of its service. So how much you spend for the operation process. So how much you do spend. So in cost, labor cost, okay, utility cost, we have fixed cost and variable cost, okay, rental. So all those elements will be under category of cost. So here we look into the type of cost. Okay, a successful restaurant or food service operation need to manage and control many costs. Food costs, beverage costs, and labor costs each have components that are related to sales level. Variable or semi-variable costs can change based on sales. These are controllable costs because the operation has certain amount of control in how it spent on this aspect of operation. So variable costs you can control them. Okay. Then we look at overhead cost. Overhead cost is a fixed or non-controllable cost, meaning it's need to be paid regardless of whether the operation is making money or losing money. So you cannot control over this. You have to pay. For example, rental for the premises, you have to pay. Okay. So that is called as a overhead cost or fixed cost or uncontrollable cost. Fixed costs do not change based on the operation sales. Okay. So all the costs which we discussed in previous slide, based on the costing, we have to come up with the budget. Okay. So here we look into the operating budget. What is operating budget? Operating budget is a financial plan for a specific period of time. So a forecast is a prediction of sales level or cost that will occur during a specific time of previous forecast. Okay. So normally people do forecast based on the previous sales record. Okay. Most of forecasting technique rely on having accurate historical data for the operation. Okay. That's why I would say that we have to look into the previous sales record historical data. The most common food service revenue forecasting techniques are based on the number of customers and average sales per customer. Okay, again, the most common food service revenue forecasting techniques are based on the number of customers and average sales per customer. A sales history is a record of the number of portion of every item sold on a menu. Most operations can run historical sales and production report from their point of sales, POS in short, system. Okay, so it's all what this slide is focusing on is on when you want to prepare your operating budget, you should have historical data. So it means that all the data on your expenses, on your costs need to be recorded. That is what we are saying here, stressing on, because if I want to do prediction, I should have the data, and most of the company, I'm referring to small medium enterprises, fail to keep a proper book record or data. So then we will have profit and loss report. Okay, a profit and loss report is completion of sales and cost information for a specific period of time. So in short, cost and profit record, we call it as a P&L, shows whether an operation has made or lost money during the time period covered by the report. The P&L or income statement helps manager couch and operation profitability as well as compare actual result to expected goods. A P&L also helps management determine areas where adjustment must be made to bring business operation in line with established financial goals. For an operation to be profitable, sales must exceed cost. Revenue must exceed cost. Then only we can see a profit. So cost control tools. So advances in technology have drastically increased the number of options available to operation in controlling costs. Software programs can be used to complete the calculation required in cost planning, controlling sales, controlling inventory, and focusing on the menu. Computer software can easily provide better access to information, more accurate and convenient collection of information, and improved analysis of that information. If used effectively, means that information is wealth actually. If we use the information effectively, technology can help in running an operation more efficiently and helping to reduce and effectively control costs. Okay, for all this we need a data, a proper data for us to run. Even though it's software, even though it's computerized thing, we need to key in all these data. Okay, so better we bookkeep or do a better bookkeeping for all the information that needed to run certain analysis. So summary for this section, every business need to obey one basic principle to survive. It must make more money than it spent. That's all. Simple principle. More money than on your spending part. Okay. Food costs, beverage costs, and labor costs each have components that are related to sales levels. An operating budget is a financial plan for a specific period of time. It leads the anticipated sales revenue and projected costs and gives us an estimated of the profit and loss expected for certain period of time. A profit and loss report is compilation of sales and cost information for a specific period of time that shows whether an operation has made or lost money. Okay. So we need to know step in controlling food costs. So here listed 7 steps that we can control the cost. Means that the spending can be controlled in 7 steps. Okay, first purchasing, receiving, storage, issuing, preparation, cooking, and service. Okay, let us look into the how to determine the food cost. Okay, food cost by definition is the actual dollar value of the food used by an operation during a certain period of time. Food costs include the cost of food sold, given away, wasted, spoiled, incorrectly prepared, overportioned, overproduced, or bilf rate. Inventory is the dollar value of a food product in storage and can be expressed in terms of units, value, or both. So under inventory, we have two type of inventory, not two type. There is a opening inventory and closing inventory. Opening inventory is a physical inventory that beginning of a given period of time. Closing inventory is an inventory that end of the given period of time. Okay, so the formula for obtaining an actual food cost accurately is stated here. Okay, opening inventory plus purchases, okay, you will get total food available. So once you get the total food available, you minus with closing inventory. Once you minus with closing inventory, you will get total food cost. I'm repeating again. Opening inventory plus purchases, you will get food, total food available. Okay, total food available. So when you minus the total food available with closing inventory, then only you will get the total food cost. So total food cost percentage is the relationship between sales and the cost of food to achieve those sales. So food cost percentage analyzed by comparing it to company standard, historical cost, or even industry standard. To determine the percentage, divide the total food cost by the sales. Very simple. Okay, so total food cost, when you divide by sales, you should get the food cost percentage, how much you spend on the food. So food cost is a variable cost. It should increase or decrease in direct proportion to an increase or decrease in a sales if all of the standard and food controls are followed correctly. So how to establish standard portion cost? Most every operation has standardized recipes that are followed every time a menu item is prepared. Okay, definitely they will have. Okay, so for every standardized recipe, an operation should establish a standard portion of cost, which is the exact amount that one serving or portion of a food item should cost when prepared according to the item's standardized recipe. Hope you all understand. So again, for every standardized recipe, an operation should establish a standard portion cost, which is the exact amount that one serving or portion of a food item should cost when prepared according to the item's standardized recipe. If you want to prepare a muffin, okay, banana muffin, so you should know how much cost of that per muffin. Okay, so you should, that detailed information you should get. Okay, a recipe cost card is a tool used to calculate the standard portion cost for a menu item. As with the standardized recipe, a recipe cost card should exist for for every multiple ingredient item listed on the menu. See, very tedious process for us to calculate the profit. Then only we will get exact accurate amount of the money that we are making. Okay, and then where we can cut down the cost. So you have to be very thoroughly spend on your preparation for the food product. So here we look at the as purchased versus addable portion cost. Okay, as purchased method is used to cost an ingredient at the purchase price before any trim or waste is taken into account. Okay, so AP method all ingredient quantity are listed on the standardized recipe in form in the form in which they are purchased. Okay, that is as purchase method. Edible portion method is used to cost an ingredient after trimming, removing waste, so that only the usable portion of the item is reflected. Using the EP method to cost an ingredient, the quantity is listed on the standardized recipe using only the edible portion of what particular ingredient. Okay, so we have AP method and EP method. Okay, so a recipe yield is the process of determining the number of portions that a recipe produces. To determine how many portions a recipe yields, calculate the total volume of the recipe either by weight or by volume, depending on how the portion size is calculated. Understanding recipe yields is one of the keys to successful food preparation and controlling food costs. The measurement given in recipes must be followed exactly. Once yield is known and properly followed, it's easier to increase or decrease the size of the recipe based upon the operation changing needs. So now we look at controlling portions. Controlling portions is very important for a restaurant to meet its standard food costs. Tools that are essential for accurate portion control include scoop, ladders, serving spoon, serving dishes, ramekins, bowls, cups, and so on. Portion scales. Another mechanism for ensuring that portions are the right size to proportion any item that can be pre-portioned before serving. When restaurant produce too much, food cost goes up. Produce too little and sales are lost. A food production chart shows how much product should be produced by the kitchen during a given meal period. A well-structured chart can ensure product quality, avoid product shortages, and minimize waste, spoilage, theft, energy cost, and administrative costs. Sales history is critical in helping management forecast how many portion of each menu item to produce on a given day. So here the menu is the primary sales tool in most restaurant and food service operation. There are a number of methods for menu pricing. So first method is contribution margin. Contribution margin is the portion of dollars that a particular menu item contribute to overall profit. To use the contribution margin method, an operation must know the portion cost for each item sold. In this rate markup pricing method, multiple raw food costs by a predetermined fraction. With the average check method, the total revenue is divided by the number of seats, average seat turnover, and days open in 1 year. The food cost percentage is equal to the, again we are talking about food cost percentage, is equal to food cost divided by the food sales. So summary for this section, food costs must be controlled during all 7 stages of the food flows process, from the actual purchasing of food item to how they are served to the customer. Food cost is the actual dollar value of the food used by an operation during a certain period of time. Food cost percentage is the relationship between sales and cost of food to achieve those sales, and most operations have standardized recipe that are followed every time a menu item is prepared. Why we need to follow every time? Because to simply reduce unnecessary costs incurred. There are 2 methods used to determine cost of ingredient in a standardized recipe: AP method and EP method. So a recipe yield is the process of determining the number of portion that a recipe will produce. Controlling portions is very important for a restaurant to meet its standard food cost. The menu is the primary sales tool in most restaurant and food service operation. Labor is semi-variable, controllable costs. Labor costs are tied to sales but not directly. Most operations have both full-time and part-time sales. Operation must be aware of the fluctuation in their sales so as to have just the right amount of staff on hand to handle customer efficiently. It is an important part of management function to make sure that payroll cost is in line with the budgeted standard. Ideal labor cost is the standard the restaurant uses to budget for staffing need. It represents what management predict will happen. So, on the labor cost factors, you have to see what are the factors that will increase the labor cost and factors that decrease the labor cost. Okay, business volume or the amount of sales an operation is doing for a given time of period impact labor cost. Employee turnover is the number of employees hired to fill one position in a year time. Quality standards also affect labor costs. Quality standards are the specification of the operation with regard to product and service. A restaurant or food service operation must meet operational standard. If an employee does not prepare a product that meets the operation standard, the item must be redone. This costs money in terms of wasted product and lost productivity. A master schedule is a template that shows the number of people needed in which position to run the restaurant or food service operation for a given time period. To make the best estimates for a reasonable master schedule, it also need to consider current trends. After determining the anticipated sales, management determine the payrolls dollars, which are the numbers of dollars available for payroll for scheduling period. A crew schedule is a chart that shows employee names and the days and the time where they work. And you should have a contingency plan because contingency planners and operation remain efficient and productive even during adverse conditions. So summary of this section is operation must be aware of the fluctuation in their sales so as to have just the right amount of staff on hand to handle customer efficiently. Four primary factors affect labor cost is business value, employee turnover, quality standard, and operational standard. Scheduling depends greatly on how much revenue an operation is bringing in and how much revenue an operation expect to bring in. Okay, quality center for purchasing and receiving. Purchasing. Prior to ordering, receiving and storing quality product, consider where the product were grown or produced. Those with purchasing responsibility should seek suppliers who are considered to be ethical, reliable, and financially stable. Okay. Receiving. Once purchase order has been made, the next step is to receive the item in the most efficient, safe, and effective way possible. Well-defined receiving procedure ensure that an operation receives only the product that meet its established standard for quality and quantity. Storing. It is a critical that operation create quality standard for proper storage. And bear in mind, food products are perishable product. So storing is important element and as well as it will increase the cost. Monitor perishable food daily to preserve its quality. Some food items have manufacturer recommendation for storing the product. Okay, so store food with a proper label and rotate all product in the storage following the FIFO system. FIFO means first in, first out. In addition to checking the food in storage facilities, the storage facilities themselves should be checked regularly to make sure they are clean and functioning properly and efficiently. Standard portion sizes, standardized recipes, and standard portion costs are all food production standards. It is important that managers ensure that standards are met throughout the food service cycle. It is important that operation has a quality assurance measures in place right up to the service stage of the food flow process. The key to identifying deviation from standard recipes and presentation is regular monitoring and the understanding by the staff that is the responsibility of everyone in the establishment to ensure quality. So to ensure quality, staff should understand the standard procedure. Okay, so all of these are just simply for you to reduce your cost. That's all. Okay, you follow the standard operating standard procedure so that we can reduce the cost incurred. Taking physical inventory means counting and recording the number of each item in the store room. Closely monitor inventory to ensure that products are ordered as they are needed. Carefully monitoring inventory also helps ensure that no product goes to waste. Minimizing waste keep costs down and sales up. Determining actual food costs by opening and closing inventory for given period. Use the latest purchase price before actual purchase price, weighted average purchase price, or last in first out LIFO method to determine the value of closing inventory. Summary. It is important to take cost control measures in all aspects of the food flow process from the purchasing to service. Standardized food production helps to ensure quality standard as well as each item is cost on the standard. Closely monitor inventory to ensure that product will be ordered more efficiently as they needed. Thank you very much. If there is any question, please let me know. We have our discussion in our forum section. Thank you. Take care. Stay safely.